but I'm still in practice, right? So can you see me or not really? Okay, well, that's okay though, right? Well, I haven't. Be good, is that what you're trying to tell me? Yeah, we didn't do one in December, right? I didn't look to see, did Jackie sign up for this deal or not really? Murray? Yeah, I looked at it briefly here. I stopped looking because I needed to get other shit done, you know what I mean? Huh? Yeah, I think she's kind of done with me, which is fine. We've been friends for forever. Roz Cole's still on here. That's funny. John Dodson too. You know what I mean? Okay. I think I'm gonna pop it open. What do you think? Tell them when we're in. Hello, everybody. We're just getting going here. Jerry Slusowitz, Pacific Financial Planners. I just opened up for people to start filling in, so let's give it a minute or two. I'm appreciative of everybody's time though, so we won't wait too long. And but I show it's 3 o'clock straight up. Should be about 50 people all together. When we get close to half of that, we'll get it going. So a little housekeeping. Again, I'm Jerry Slusowitz. If you're new here, appreciate it. I've been a money manager for 35 years, doing the Zoom calls since COVID came along. It's great for clients to hear what's going on and their guests. And, you know, we've had other people join us as well. So if you're joining us today for the first time, it is a Zoom webinar. So if you want to ask a question, if you scroll your cursor down at the bottom of the screen, you'll see there's Q&A and then there's chat. And if you type it in chat or Q&A, I'll see it come up and I'll be happy to answer your question. If it's something we're getting to, I will delay it a little bit, but generally I take them as they come in. But unless it's something I'm getting to in a minute, then I'll take it down the road. I'll read the question for everybody so people will hear what the question was. So I'm not just randomly answering questions. But again, want to get this going. You know, this is kind of Happy New Year. I guess, you know, everyone's going, hey, wait a minute, it's January 24th. What do you mean? That's a long time ago. And it does seem like a long time ago, at least to me. The month's almost over. But we do these topics, and we didn't do one in December, and we moved the Zoom further back into the month now. It used to be the middle, and now it's kind of near the end. But, you know, we're gonna work on that. I think they're gonna probably, if you go to our website, you'll see that most of these Zooms are gonna be the second to last week or the last week of the month. So you can invite friends or whoever wants to be part of it. No problem, just bring them along, and it's all free education. There's no obligation, there's no anything. If you have any questions, as I said, go to Q&A at the bottom, or go to chat in there. Hey, Amar, how are you? Glad you joined us. So everyone, again, has a chance to either ask a question or chat, and I'll get to every single question, I promise, as we go forward. So new year, new start. Why? Why does it have to be a new year, new start? Well, because I know from the portfolios I was looking at the end of last year and so far the beginning of this year that most people that weren't my clients did very poorly in the markets because they failed to understand the number one risk in retirement, which is volatility on your portfolio. I mean, that truly is the number one risk in retirement, is volatility. And the problem with that is that, you know, volatility cuts both ways, and it could go up or down. So I'm already getting a question from Steve saying, do you think the bottom was in last October? You know, I kind of think so. I mean, I was really disappointed, I'll be honest with you, the way the year ended, because we were really close to the bottom in December, the very end of December. So we're going to talk about my predictions for 2023 coming up, Steve, so if you can hang in there. But I do think that no matter what, just to answer Steve's questions, do you think the bottom was in last October? I do think that we're not going to have another 19.5% down on the S&P and another 33% down on the NASDAQ, which is what the numbers were for 2022. And so I'm going to share my screen here with you guys and show you that, because it's really important that you try to understand what's going on. When you have, let's say, 100 grand, okay, and you lose 20%, which is what the S&P was 19.4% on the year last year, that's $20,000, right? That's 20K, right? So if you lose 20K, that means you have 80,000 left, okay? So when you have $80,000, if you get a 20% return, well, that's 16,000. You're only at 96,000. So you need a $20,000 appreciation on 80,000, which means you need an upside of 25% to break even. And that was the S&P 500. Okay, so you know, they say, oh, you want to miss the best days. Well, you know what? If you miss some of the worst days, you have a lot less catch up to make. Let me take that example a step further. You had 100,000 and you were in the NASDAQ, you know, last year, and that was down 33%, which is 33,300. Okay, you know, ... So now you have 66,000, you know, whatever, 700. Well, what do you need in terms of return? You need a 50% return. You lose 30, right? You lose 30%. You need to make 50. See, it's not what you make, it's what you keep that counts. And that's why it's so important to have kind of a new start, new beginning, where you're looking at things differently. All right, that's really important, because again, if you're drawing money off, now let's say on that 100,000 you're drawing $4,000 a year off, which is just 4%, or you know, 5%, $5,000 a year off, not even $500 a month, and now it drops down to 66,000. You need more than a 50% return to get even, because you're still drawing now, instead of 5% at 5,000 off of 100, but you're now drawing 5,000 off of 66,700, you're drawing 7.5%. Because you need to have that income when you retire, because you gave up your paycheck to be retired, and you're drawing off your portfolio. So it adds to that down where you don't really recover. That's why, again, you cannot have these type of 20% to 33% returns, in your portfolio if you're drawing money. Now, some of you guys fairly wealthy, fairly affluent, where you're not in a situation where you need to draw money, good for you, and you can maybe ride this thing out. That's good as well. But why would you want to ride that out? Why wouldn't you have something paying you some sort of income? We've talked about this a number of times. And I'm going to share my screen again. Back to this whiteboard here is when you invest, you're investing for return. I'm going to put a T in front. For total return comes from, most people think of the stock market and growth. And then it comes from two sources, growth plus income. Okay. And for a lot of my clients that are retired, this income component is more important than the growth component. And for many of you last year, when this growth turned into a loss, you didn't have this income component. So I was reading a quote by what's his name, the owner of the Mavericks, the billionaire, Mark Cuban. Cuban said, and this was his quote today on my Art Cashin deal. He said, buying growth stocks that don't pay dividends, is like buying baseball cards. You're hoping to convince somebody else of a value that's higher than the one you bought it at later on. The greater fool theory, they call it. Where if you demand income from your investments, if you demand that every month or every single quarter, the investment portfolio comes out and says, here, I've got something for you. Here's $100 for being a shareholder of our, investments. We're going to pay you a 5% dividend. We're going to give you $100 every quarter for being with us today, not waiting for price appreciation. That is what our clients are doing. And that's kind of a little bit of the gist of what I'm going to be talking about today, is investing for things that pay dividends and pay interest. Now, the thing is that, historically, prior to mid 2022, 6 months ago, 9 months ago, for 10, 12, 14 years prior to that, interest rates were zero or negative. And what happened? We all heard about the Fed raising interest rate, the Federal Reserve Board. They're the banker of last resort. They loan money overnight to the money center banks, to your Bank Americas and Chase and JP Morgan, et cetera. They loan those people money overnight. And the rate that they charge is the cost of money. And that has gone up dramatically. They had a 1/4 point, then they had a 1/2 point, then they had 3/4 points 3 times, and then followed by a 1/2 point interest rate hike. So that's a lot of hikes. And to now where interest rates in money markets, in CDs, in treasury bills is over 4%. And some of you going, oh yeah, but wait, inflation is higher than that. Inflation is still 6.2. Yeah, but sometimes when you're in a market that's dropping, a bear market, I need you guys to understand, that was the definition of bear market was a 20% decline. And we were down 25% in October, to answer Steve's question. We were down 37% on the NASDAQ in October. And by the end of the year, we had kind of bounced back up for a third time. And we were still down basically 19.4 and 33.4% on those two indices respectively. That is a bear market. That's a bad market. So while you're waiting for the bear market to anneal itself, there are opportunities versus just sitting on your hands. People sitting on their hands. Wait, well, what do I do? What do I do? Well, invest for income. Now, there's a lot of people out there saying that, and again, I used to have this manager. His name was Gene DePatty. I don't know what his status is these days. He may not be with us anymore, but he had a few nuggets of sage advice. And his always was, don't fight next year's war, or this year's war with last year's generals. The heck did that mean? He meant that whatever the leaders were in the last bull market, they're never the leaders in the next bull market. And so there's a lot of people talking about value. And again, value are companies that are perceived as a value today, a good value. they're cheap, they pay a dividend, they have a low PE ratio. So the S&P 500 is a PE ratio of 18, so things that are cheaper than that. And there's a whole bunch of stuff out there that look pretty good, that have pretty good dividends and pay those kind of dividends. I mean, and have that kind of growth and income. I mean, one company, and again, I'm not making this as any recommendation, please. Before you buy, you must check with your financial advisor, have a discussion with me. So I'm not saying this is right for everyone. What I'm showing you is an example of what I mean by a value company. You can probably see this chart on Intel, right? So what you see is this thing used to be way up here in price, which is, over $60 a share. Okay. I think it's $69 a share. And this is back in, get this out of the way. This was back in 2021. It was 68.40. You can see that. And back in even further, 2020 was $69 a share. So this was kind of peak price for Intel, right? And now what you see, you saw it go from almost $70 a share to around $23 a share, and now it's $29 a share up here in the right-hand corner. You can see it. So at $30 a share, $29.92 compared to $60, it's still down 50%. So is this a good value? Just because it's cheap in price does not necessarily mean it's a good value. But let's take a deeper look. Here's the PE ratio right over here on the left-hand side, and you can see it's 11. And in the last 5 years, the PE was as low as 8 and as high as 14. Now, what does that mean, PE ratio? Well, on its own, it means nothing. It means the price, and we're going to call this price up here in the upper right, $30 a share, is 11 times their trailing 4 quarters of earnings. So your last 4 quarters were 59 cents, 29 cents, 87 cents, and $1.09. I guess I should have added these up ahead of time, but I didn't. So if you add those all up and you divide that, or you don't have to divide it, you'll say that that's $2.84. And this thing's trading at $29.92. So if you take 11 times the total of the last 4 quarters of earnings per share times 11, the P to earnings, price to earnings, you got a price of $29.92 versus earnings of $2.84. And historically, that's on the cheap side. And if the stock market, the S&P 500, has a PE of 18, then this stock is cheaper than the overall market by almost 50%. It's 50% cheaper. Okay. And this is a microprocessing chip networking company that does memory and storage. All right. Here's the next bit about this. I'm going to clean this up. I'm just going to get rid of everything we had. Is the yield. See that dividend of almost 5%? Can you see that? 4.9? And you look at cash flow of $8.16. That's free cash flow after all earnings. So 5% of 30 means it's paying about $1.50 as far as a dividend. And yet these guys have $8.16 to cover that dividend in free cash flow. So now suddenly you're getting paid 5% while you wait. You're getting paid 5% while you wait. What a good deal that is. So it's a tech company that is down in value, over half. Yes, off its bottom, but that to me is what's called a value stock. Now, again, let me just point out the negative. You look down here in the bottom left, you'll see that their earnings, you don't see the chart anymore. Okay, hang on for a minute. Let me see. I took that off. Down here in the bottom left, you'll see that the earnings have been declining quarter after quarter on declining sales. So that's your risk, but you're buying a cheap stock with a good dividend. So if it does go sideways for a while, like it's doing right now, it's been really kind of going sideways if you really look at it since about September of last year. You're getting paid 5% while you wait. And there's a number of companies out there besides this one here, that do the same. There was John put out there, and John's been really good at stock picking. He participates in these things a long time, is PBR, which is Petrobras, which is the Brazilian petroleum company. Yeah, it's not quite a 63% yield, but I mean, it really does pay a good dividend. It's a little bit different. But you can see oil stocks have been going up, and the other one he put in there was PBA. And again, it's another version of this is Pembina Pipeline. Generally, these are limited liability companies. The pipelines in general are doing pretty good. You can see this thing's forming a wedge, if you will. Generally, it's going to break out one way or another. So you got to watch that, make sure it doesn't go down. You can see here's a 5.4% dividend. There's other ways to play that without getting a K1. Here's another one. This is Alerian. It's an exchange traded fund of a bunch of pipelines versus taking the risk in one. The chart looks very similar to the last one, but slightly going up. And this is paying about a 7% dividend. That's an exchange traded fund, and there's no K1s. So, thanks, John, for your input on that. And they have been doing well. And again, it comes back down to oil and gas. So the other thing out there that I want to talk about is how to invest this money in a new way this year, is looking at this income style that we were talking about. You see this TR equals growth plus I. On the income, that's what I was talking about. Let's say a 5% dividend or a 7% dividend, etc. But there's also individual bonds, okay? And so what I want to show you here is, goodness, where is that? Let me move this down here. That's not it. Sorry, I've only been doing this for almost 3 years, and here we are still having problems. Okay, let me see if I can share this thing. I'm going to stop it. I'm going to try it one more time. And there we go. So you see, this is a list of insurance companies, annuities that are fixed rate. Now, this is not good in California. Here we go. Ocean View right here. California rate, 5%, right there in the middle. You can get 5% for 3 years, okay, in an annuity, fixed rate, every year, 5%, pays every day, compounds, etc. You could go out 4 years, and you could get, where is it approved in California here? This is for $250,000. You get 5% here as well in a 4 year. And if you go out 5 years, right over here on this Americo Platinum Insured, you get 5.4% in California. And, why can't you get the 5.65? Because we're in California, and the insurance, we vote for them every year. The insurance commissioner is stopping you from getting the best deal out there. I don't know why, but they do. So, but in California, we get 5.4 for 5 years. Now, that's really good. I mean, it really is. I mean, you could go out and get a money market overnight that's paying over 4%, and you could go out and buy a T-bill for 3 months or 6 months and get somewhere between 4.3 and 4.6%. You go out 9 months, you're closer to 4.7%. So if you're trying to hide out from the market and you want to get real rates of return, there are places for you to do it. So, that's always the key. But before you start making changes and going forward, one of the things that I think is really important is to know where you are today. So how do you do it? If you haven't done this yet, it is imperative that you do this, and that's figure out where you are. I gave you the S&P, which is the major market indices, and I gave you the NASDAQ. Now, the thing is, if you had a mix of stocks or stock portfolios of mutual funds or ETFs and bonds, but you didn't use individual bonds, you used bond ETFs or bond mutual funds, those went down around 15% last year. It depends on if you had a shorter bond portfolio, maybe 6 or 7 or 8%. But a lot of these things went down 15, 16% because it's not an individual bond, it's a bond fund. All right. Steve, let me get on that Jeppy in just a minute. I want to finish this thing on the bond mutual funds. So let me go into this real quick here and share my screen again with the whiteboard. Here we are. And if you're looking at the safe investments, you've got banks, okay, bonds, and then you've got insurance companies. So I showed you some of the longer term insurance company rates. You can get for 3 years, you get 5%, and for 5 years, you get about 5.4. And again, this isn't for everybody. These are, you know, long story dissertation. That's you locking your money up and tying it up for that length of time. And, you know, but what do you do on the short term is you can look at the CD rates now. CDs are somewhere around the 3 to 4% range. And again, when you're looking at treasury bonds, treasuries right now, those rates are, you know, 4% to about 4.7%. And again, so what I suggest people look at is have cash money paying in a money market, fully liquid, and then start going out and laddering 6 months, 12 months, 18 months, you know, 2 years, you know, you can go 3 years, 4 years, 5 years. So you got, they call this a barbell. You have a short-term ladder that just keeps rolling into itself, and you keep rolling this over, keep rolling every 6 months, keep rolling it over, and then you have this longer-term strategy that's going to pay you more. And you have what's called a barbell strategy. If you've ever been at the gym, you know, if you look at me, you can see, hey, I need to go to the gym. But, you know, you'd see that this is, you know, a great way to come up with a strategy. They call it the barbell strategy. And you want to use individual bonds because, see, with an individual bond or an individual CD or an individual insured annuity, fixed rate, you have two guarantees. There's two things they guarantee. One is that if you buy it for $1,000, a bond or a CD, a treasury bill or an annuity, that at the end of the term, the issuer is guaranteeing you $1,000 back. Now, if it's a CD, then you know you have FDIC insurance, Federal Deposit Insurance Corporation, corporation of the federal government. If it's a treasury, well, you know you got the U.S. Treasury who backs the FDIC. That's the safest. If it's an annuity, then you have they're reinsured by other insurance companies, and then they're backed by the state guarantee fund, which means they're backed by the state that it was issued in. Many of you on here are from California, and so you know California would be the 5th or 6th largest country if we're an individual country. You have a guarantee that you're going to get your return of principal, and then the second thing they guarantee you is a set rate. So whatever that rate might be, let's call it 4.5%. So they're going to pay you the rate and the income guaranteed. That's when you buy an individual bond or security. Now, many of you probably don't know because you haven't been doing this long, but prior to 2007, 2008, the financial crisis, you were getting around the same rates, 15, 17, 18 years ago. So that's how good rates have gotten. They've gotten before that financial crisis. I used to do a great business because I manage conservative portfolios for people who don't like losing money. If you have a question, you can always call our office, 949-219-0692. I'll give you a free consultation. We'll do this over the phone. We can do it on Zoom. You can come in and meet me if you're local. You know, so however you want to do it, and I'll review your portfolio. But it's really important that you look at things that offer these guarantees, because with a bond fund, a lot of people had a bond mutual fund or a bond ETF. Guess what? The principal, you don't own the maturity. You're not guaranteed to get your money back. And you don't own the rate. It could pay more, it could pay less. And your principal could go down. As interest rates go up, as rates go higher, the price, which is what you own, is going to go, and it's in a direct inverse relationship. So it's important to understand, you know, that a lot of you that had bond mutual funds and some stocks in that old 60-40 thing last year, you know, you probably still experienced, you know, 14, 15, 18 or more % losses. And so it's important to know exactly how you did, where you stand today from 2022. And the second thing that's really important when you review the overall net, and how you do that, if you look at your December statement on the upper right-hand side, it usually shows January 1st, beginning value, December 31st, ending value. You can take any withdrawals, you subtract that off your beginning value, and then you just calculate that to the ending value. That's your percent return. But secondly, and really probably even more importantly, is you want to know what were your three best winners? Where did your winners come from? What did you have that went up in value or paid you an inordinate amount of income to be able to give you a total return of some positive number last year? You should have had some stuff in your portfolio that made you money. If you didn't, call me 949-219-0692 right away, because you need to change something. Don't be afraid of change. That was my first bullet point on the invitation to this. Is if you're doing the same thing over and over, expecting different results, you're crazy. And in addition, what's really important is to understand that we've been in a bear market. Yeah, the markets are up 4 to 8%, depending if you're looking at the S&P or the NASDAQ year to date. But we've been in a bear market, and we're still in a bear market. And when it comes to the life stages of investing, as you get closer and closer to retirement, or once you're in retirement, there's no do-overs. You only get one chance to get it right. So you kind of got to change from the accumulation strategy, the one of the total return and growth, stock market oriented, to one of income, which is dividend paying value stocks that also can go into individual bonds that are, or insured products that are paying you positive rates of return as a distribution. We can take the income. Some of you go, well, I don't need income. Well, great, just reinvest that either into the best thing or not. But if you know what your three best were, that's great. But you want to know what your three worst were as well. Why? Okay, so my mom grew up on a farm. So when we were kids, we'd go to Wisconsin every summer, and sometimes we'd spend weeks there, or even sometimes a couple of months during our summer vacation. And guess what? Well, Grandpa put me to work on the farm. So a little bit of a farmer boy and an engineer all together. And one thing that they taught right away is there's these things called weeds, right? So you might have a flower garden or a garden of vegetables or whatever, and the weeds don't do that garden any favor, but they sometimes can grow as big or if not bigger than the crops or the flowers. So sometimes it's not, well, you could plant a flower or another vegetable in front of the weed. It's one thing you could do. Well, Grandpa would probably be laughing in his grave right now if you did that. The other thing is to do is to pull the weeds, and the garden does better. It's the addition by subtraction. Some people say, well, that's not a true thing. No, you subtract out the losers in your portfolio, and it's going to add value to your portfolio by getting rid of the losers. A lot of people just don't know how to do it. They think sell's a 4-letter word. It is, but it's not a bad 4-letter word like some of the other ones. All right. So you've got to be able to sell once in a while. What should you sell? You should sell your losers. That's what you should do. You want to cut your losses quickly and let your profits run. So that's a Warren Buffett stating right there. So when you're getting into that distribution space, you want to have income, and things that aren't paying income or things that are losing value quicker than the rest of the portfolio. You want to know what your three best and your three worst were. And if you don't know how to do that, you really don't know how to determine that, then I'd be happy to meet with you. Because the reality is this, and I've been doing this a really long time. This is my 36th year of helping people. All right, so this is a plot of return. This is 0%, meaning that you don't make any money. And here's the pluses, okay? So here's plus, we'll make this plus 10, and we'll make this plus 20, etc. And this is the minuses. So we'll make this minus 10, and we'll make this minus 20, okay? So let's say that the right amount to invest is somewhere between 15 and 17 positions. And there's all kinds of studies out there that show that true diversification, as long as you're not buying all tech stocks, I have about 15 different tech stocks. You're not diversified. But if you buy different, industries, whether it's ETFs or mutual funds or bonds or whatever it is that are diversified, if you have 15 to 17 positions, you get true diversification. What I do is even more simple. I try to buy 5% positions, and I want to have 20 positions to equal 100% of my portfolio, right? So if we have 20 positions, I know over all these years that I'm going to get probably 5 of these things that are going to be somewhere between 0 and plus 10%. All right. I'm going to get another 5 of these things that are going to be somewhere between 0 and minus 10%. All right. And then I'm going to get 5 of these things that are going to be, somewhere between 10 and 20, and then a couple that are going to be 20 and above. All right. But I'm also going to get, just through natural security selection, because it's not about picking winners or losers, you're going to get a couple that are down between 0 and 20, and then you're going to get a couple that are down more than 20, even 30%, like the NASDAQ last year or the S&P last year. And so if you have this basically standard distribution of returns from the positions you buy, because it's not about picking positions, and you get rid of these big losers, now this amounts to almost 0, and you're getting all your return from your few big winners. Because again, if you redistribute these 5, you're going to get a 0, you're going to get a plus, you're going to get a minus, and then you're going to get another big winner, and you're going to get another big loser. But if you stop your losses at a minus 10%, you never get the big losses. And all your return now comes from these 6 positions. Does that make sense? You guys follow that? That most of your positions aren't going to do much for your portfolio. That's why getting income, getting dividend, getting return out of your portfolio is so important out of these, because now not only are you getting these big winners, you're getting income from everything. Even you might have gotten some income out of your big losers as well before you sold those, because it might have taken a while to drop below that minus 10% mark. But that's what we do by talking about stop losses or buying insured investments or guaranteed investments, so you don't have to take big losses. So what's going on in today's market is it's very interesting. The year started off pretty poorly because it ended really bad. Okay, it ended up big sell-off into the last day, no Santa Claus rally. Santa Claus left us all a bunch of coal, but we're starting to turn around a little bit. All right, so let's take a look at this thing here. Go back to the new share on this thing here. And what I want to do is share it with this market picture here. You see this? So we back to the stock market? S&P 500, right? Okay, so this is the S&P 500. This is the major market. So this was January 1st last year, right there at the peak of the market. And what did we do? We went down and came back. We went down more and came back. We went down more and came back. And we didn't go down quite as far. This is the October low that Steve asked about earlier. And now we're coming back. And if you look at it, if I just draw this downtrend line, look at that. Every time we hit the downtrend and the 200-day, we failed. And guess where we are today? Right on that downtrend. Here it is again. Here now I'm showing the daily chart. This is a year ago, way over here on the left. All right. A year and 3 weeks ago. And all I'm really doing is playing connect the dots between here and this first downtrend. But since I'm on a computer, I'm just going to play connect the dots. I'm going to let it ride itself out. And if you look, here we are kind of peeking our head above it. Guess what? It means you should have some positions in the market because this low is in place. And now we might be on an uptrend because we seem to be breaking over the downtrend. Look at this black line here. I don't know if you guys can see that black line, but that's the 200-day moving average. Look at this. They say, how do you know if something's good or bad? Well, if it's above its average price for the last year, it's doing better than it has in a year. If it's below its average price for the last year, then it's doing worse than it has in the last year. So the 200-day moving average is kind of your average price for the last year. So you can see, went below it, it kind of struggled, went above it, went below it, went above it. And then what happened? It failed. This was the beginning of last year. The market failed. It failed right here, went back and tested the bottom side of that. This was the start of the war over there in Ukraine. And then it tried to fake us out and went right back to the average price, to that black line of the last year. Failed again and went to a lower low. All right. And then here, rather than break it out to the new high, we fell into the end of the year. And here we are starting the year up again. Now, generally speaking, I'm going to clean this up. And I know I talked about this. If you've been joining my webinars, you can have anyone join. Anyone can get on here. Just tell your friends it's free. There's no obligation. Yeah, you sign up, but you can get off any of these lists. They form a W. This is the bottoms, how bottoms form. And the right side of the W is usually lower than the left side. Look at that, it's lower. And then you start going up. And so, it's not exact W, but we are looking like we're forming this W, which means that low from last October could be the low for the market. I kind of believe it is. Now, when do you buy? Well, one time you buy is when the market stops going down. Well, and it looks like it stopped going down here. It's peaking above it. So you could buy a little bit here, a little bit here, and then when you pass this midpoint of the W, you could buy a lot more there. And so you could take 3 shots at it. But the reason I say you got to know where you are today is if you're 80, 90% in the market right now, you don't need to take any shots right now. You probably got enough. Maybe you need to rebalance your portfolio, reallocate your portfolio into something a little bit different, a little bit better, things that are outperforming the market here on the upside as the market's going up, or things that pay a pretty big dividend and have a low PE ratio, like I was talking about with the value stocks. All right. So here we are now in predictions for 2023. And by the way, if anyone else has any questions, go to the Q&A or the chat and type it in. And I want to get to your questions, as quickly as possible here. But my prediction for 2023 is that I think that we're more or less, if there is a recession, I believe we had a recession last year. The first 2 quarters of last year had negative GDP. We were below 0. That is a textbook definition of a recession. Now, some people are saying we're going to have an earnings recession, and they're saying, oh my goodness, earnings season's upon us and it's going to go down. Maybe there is an earnings problem out there. Maybe that does happen. But I got to tell you, we're in a pretty good market right now, where it seems to be shrugging that off. So that's what's important is to understand what the market's doing, not what people are saying about it. So, earnings so far, and we're in the heart of earnings season, haven't been too bad. I know that Microsoft was lower today, and there's a whole bunch of earnings coming out this week. Boeing and ASML, the chip stocks are coming out. But we had a lot of banks. So it's really important to watch what the markets do and ease your way back into it. I liken it to learning how to swim. If you didn't know how to swim and you're by the ocean like we are here, blessed here in Southern California, would you go to the end of the Newport Pier and then say, hey, teach me how to swim, let's dive into the deep end, and then we'll swim to shore? No, you're going to start on the shoreline and get ankle deep, and then knee deep, and then waist deep, and then chest deep, and then you're going to be swimming. So same with getting back in the market. If you want to be for your portion that has risk, you can ease your way back in the market. I think it's looking better. I don't see the real reason for a bad recession. I see tons of layoff going on in the tech companies. That's why these tech companies were all down 50 to 70% last year. I don't see that being a problem. I really don't. In terms of corporate earnings, maybe we or GDP, maybe we get flat growth, but people have near-term resonance. I don't know what's called cognitive resonance. You look at the last 2 bad markets, the last 2 recessions, you had the financial and housing crisis of 07 through 09. I'll be honest with you, I thought our banking system was going to collapse. I mean, I was really worried. The way they handled it, I thought was completely wrong, but nonetheless, that was bad. And it was bad for earnings, it was bad for housing. Now most people with houses, they've refinanced it somewhere between 2.5% and 4%. They can afford their mortgages. Okay, we're not in a situation where people had 100% loan to value and a mortgage at 7-8% like we did in 2007, 2009. Most people are in there. Now, do I think with the cost of money it's 6.75% when a year ago it was 3%? So $1 million home, if you borrow $1 million, is $67,000 a year cost of money versus $30,000 a year ago. Yeah, is that going to slow down new housing sales? Yes, it will. But I mean, 10%, 15% slowdown max, because the people in their houses are just going to go, well, it's kind of like when the economy goes bad, people drive their cars longer. Okay, maybe that's what's going to happen. I don't see how that's going to adversely affect the majority of Americans. The majority of Americans are going to be fine. The majority of Americans are going to keep their job. We have very low unemployment. It's hard to get people. Hey, ask me how hard it is to get people to come to work. I had a lady I hired. My daughter decided not to be in this industry, so she quit. And I was trying to get her involved. She gave it a year, didn't like it, gave me plenty of notice. Put the ads in. I thought I was going to have this woman start January 3rd. She asked for an extension, and then asked for another extension, then asked for another extension. So I finally gave up on her, and I brought in another lady, posted the ad again, and she started yesterday. She worked all in one day. We didn't have any arguments yesterday. It's a pretty good day. Everybody was real positive. Maybe next time I get a new person here, I got to buy lunch or something. Maybe that's the idea. Nancy, put that down. Let me buy lunch so they have a better day. But they just saw that it was a job. That's all it was. Is it a hard job? No, not a hard job. This is a positive atmosphere, very positive atmosphere. But people don't want to work. People want to stay home. So, I think this unemployment thing, there's plenty of jobs out there for people who want to work. I don't think we're going to have this massive unemployment because the labor force participation rate is at low levels. So there's plenty of job postings out there for anyone who becomes unemployed. It might not pay the way they used to pay. That might slow down the economy a little bit. But a 2001 to 2000 to 2003 economy, no. 2007 to 2009 economy, no. I think we're going to maybe have slow growth for a little while. We got a lot of debt. Maybe we have slow growth. So again, why that income component is so important for you to have some level of income, whether it's individual bonds, whether it's CDs, whether you're going into these insured investments through annuities, or if it is stocks that are low PE, high valuation, because they pay good solid dividends, that is the way to go. So I think we're going to have a slow economy the first half of the year. Now, again, generally speaking, recessions only last, somewhere around 6 to 18 months. I mean, the long one is generally 18 months. So I'm going to share this again with you, screen share here, and we're going to go back to this S&P 500. And this now is a multi-year chart. This is 1999. So this was the 2003 recession, and the market dropped 50%. But what did we have? We had a whole different world here. In the 80s and 90s, you had this super long growth trend heading into this, where we went through the technological revolution. I mean, remember, we didn't have smartphones, prior to this. We didn't have email. I mean, that started when you were trying to get on the internet in the early 90s. It was that dial-up through AOL, it was getting through, and a picture took a long time for the screen to refresh. So the valuations got to 42 times earnings up here, an unreal number. And so there was half of this was the correction just in the PE ratio to get down to a more proper valuation of the market. And right around 18 months into it, about August of 2001, right when I thought we were ready to recover, what happened? 9/11 hit. There's 9/11. And then we started to get into the whole Gulf War bit. That was an attack on the banking system. So to me, this was two recessions. You had recession one, the PE recession, and recession two was the attack on our financial systems and gearing up for war. What do I mean by attack on our financial systems? Well, whole businesses went under. I mean, they destroyed all the records. I mean, it went down with the towers. And people were like, hey, I had $1 million there. And they were like, do you have a statement? Do you have something you can show us? Because we didn't have all the backups. Now you go to Iowa, you go to the Carolinas, you see these fields of these big fans in these rooms. That's the cloud. The cloud's not up in the cloud. The cloud's actually in Iowa and North Carolina and places like that, Texas. You got the clouds on Earth, and you have these multiple backups from banking and financial records. That was a whole redo of our system, which caused two recessions, in my opinion. And so that's why it was a 50% decline. Here's 2007 to 2009. Now you can see that whole thing started in November of 07, was when the market started to drop. And it was done by March of 09. I mean, that's when this recovery started, March of 09. That's 18 months. Well, if you look at the NASDAQ today, let me show you the NASDAQ. and you go back and you look at this peaked out last year in like October or November. And if you look at the S&P here we go. This should show right here. Well, no, it doesn't show. It's too big. But and the S&P peaked out. Now we're on 13 months. So, you know, the market, let's say there is some more bad news out there. It's going to happen in the first half of the year. And it's not going to be the bad news that we know about. The bad news we know about, we already know about. That's already factored in. They're going to raise rates a few more times. Okay, you know, Jay Powell, he's been very clear on what he's going to do. And these people guessing, oh, he's going to do what he's not going to do. He's going to raise, you know, we're going to get at least 3 more quarter-point interest rate hikes. Could be a half a point in there as well. But they're trying to slow inflation. We brought it from 9%, over 9%, down to 6.2, and it seems to be slowing. We're seeing gas prices come down. We're seeing, you know, many different things come down in price. Some things aren't, but we're seeing the slowing of inflation. We're seeing the slowing of economy. But is that a depression, a deflationary environment, or is it just a slowing of an overheated interest rate? I think it's a slowing. So let's say the first half remains troublesome and we go sideways. Therefore, you should have these income ideas. Maybe you should be out of the market using banks, bonds, and insurance companies and get your 4 to 5% rates while you wait. So if the second half of the year, after 18 months, I mean, this market, unless there's some new thing, you know, North Korea nukes Japan, you know, or South Korea. Well, you know, I can't predict that. That'd be a new thing, right? You know, China invades Taiwan. That's not going to happen in the next 6 to 9 months. But let's just say it did. You know, yeah, that's a new thing. But as far as knowing that there's going to be slow earnings for a while and some higher job openings for you know, companies cutting back costs, yeah. Are those people going to be able to find a job? Sure. Are they going to be $300,000 programming jobs? Well, maybe not. Maybe there's other jobs they're going to have to take to fill in the time. So at some point, the market in the next 6 months will start looking forward to a brighter future down the road. And do I believe in that? I believe in it 100%. I do not see another 20 to 30% decline. I believe those people, those pundits out there saying that sort of stuff are the people out there who last year didn't see that the market went down so much. They took their losses, and so now they're, you know, hoping that it goes down more while they reallocate. So it's very important to have some sort of strategy for that. All right, somebody asked me about, Steve, you asked me about JEPI. JEPI is the symbol, it's JEPI. Again, none of these are things that you should buy without talking to your financial advisor. So here we go, JP Morgan Equity Premier. So you can see this thing last year was up in the $60 range, $62 a share as of April, and now it's 55. So not a horrible decline, but you know, around 10% off. Now at one point it was 49, so that was down, you know, probably close to 20% off of its peak. But you can see it's still kind of in this downtrend mode. It does pay a very handsome dividend. This is an exchange traded fund. I love ETFs. Look at this dividend, 11.5%. The way they come up with that is they do straddles on the market. That's using options, stocks and options on both sides, long or short. And these guys are trying to minimize volatility and maximize return. So the last few years in 2020, it hit 49, then it hit 53 in 21, it hit 49 in 22, and the highs were 56 with 63 and 63. So you're kind of in the midpoint right here, and this dividend is what has it being very attractive. From a price standpoint, it still can't get above this 200-day, that black line right there. You got the 50-day. Now see here is, let me clean this up a little bit. Here you go. See this red line? That's your last 50 days. That means that you take today's price, closing price, because the market's closed at 1 o'clock here in the West Coast, and then yesterday's closing price and 48 other closing prices, and add them up. That's your near-term price movement. And then, so if the red line's going down, near-term prices are falling faster now than they were before, and it was falling all last year. And then the black line is your 200 days. So you take today's closing price plus 199 previous days closing price, consecutively, and that's your average price for the last year. So when the 50-day right here on this left-hand side, if you can see that where the red line went below the black line, they call that the death cross. In parlance for these technical guys, they call it the death cross. And they say sell. If the 50-day goes below the 200-day, sell. And look what would have happened. If you sold it that day, that price right there, I'm going to show it to you in a box. Right there, you can see the 50-day was 61.12, the 200-day was 61.14. So it went right below it that day, which was March 2nd, and the stock was at, the last price was $59.52. You could have sold it right here because of the death cross, right there. And when it dropped all the way to 49, and as I mentioned, it was 59, right? 59.57, you'd have saved yourself basically almost a 20% loss had you held that. Now, look at Converse. That was history. That's what happened then. That's why you should watch these things. And if you're not watching it, you better work with somebody who is, because it's not just guessing and holding and hope. I mean, if your strategy, is to hold and hope and say your prayers, not a good strategy. I mean, really, that's not what, not what this is about. I don't want to get into a religious discussion, but I don't think God was all about, helping your stock portfolio. I think it was a whole different purpose on that. So, it's not good. You got to have some strategies out there that would actually work. So if you look at now, it's same stock, JP Morgan Equity Premium. It's an exchange traded fund, which will track the S&P 500. But what they're doing is they're not going to just track the upside of it because it didn't go down as much. Well, I guess it kind of did, but it's going to track getting this income from the options that they're writing. So now you've got this red line approaching. You can see now the red line bottom right around here in November and started going up, which means that the near-term prices are rising faster than long-term prices. But you can see, well, gosh, no, Jerry, the prices are going down again. So you can see this red line is almost there to the black line, it's 50-day and the 200-day. And if it crosses, and even though I only have red, they call it the golden cross. So I would not buy this position, even though it pays 11% dividend, until it goes above the downtrend, ideally somewhere around 56.90. And this means the 50-day will have crossed the 200-day. You get the golden cross. You'll have a whole bunch of reasons to buy that. And if you bought it at that point in time, the lows right back here were somewhere around $54.50. So if you paid $57, call it, you could put a stop at $54.45 and risk $2.50 or 55 cents, not even 10% on something paying probably at that point in time a 10% dividend in an uptrend. That's how I play those positions. And again, when I say play, you can see it's very, very serious because we're looking for income, we're looking for safety, we're looking for protection of capital. We have a strategy to not have that dispersion of returns by getting rid of your big losses by having something called a stop loss. All right. Any more questions out there? Because we've covered, don't be afraid to change. It's really important. You got to know your best three investments, your total return on your overall portfolio, what your best three were, and what your worst three were. If you don't know that, by the way, I'm going to call out a lot of people here. People get mad at me, they send me emails. You're not a conservative investor. I talk to all these people. Oh, I'm really conservative. Well, what are you doing about it? Well, I've got a guy that manages it. Well, ask your guy what your best three and your worst three investments were. And if they don't come up with it for you, you need to make some changes. Don't be afraid of change, because if that means that they don't know, and if they don't know your worst three investments, what do? They're managing your money for you. Remember, I showed you that dispersion chart. I want to show it to you one more time. This is really important. I want to go back to that screen one more time here. Right here. I know that this is messy, but this is 0% return, meaning most of your positions are going to be up a little or down a little. You're going to get a few big winners, but if you don't have some sort of safety net, some sort of stop loss, you're going to get a few big losers, and that's going to kill your returns. What you want to do is not take big losses by having a safety net on your risk investments and letting most of them do nothing, collect some sort of dividend out of those that aren't doing much. And then these big winners will drive the return to your portfolio. I've been doing this 36 years now, 36 years. And, you know, I got to tell you, there's something to these strategies because I have happy clients, no complaints in 36 years. Look it up. You can go to brokercheck.com. Look, guys, I appreciate everybody being on here. If I can help you, if you got any questions, it's free. There's no obligation. There's never any pressure. You know, the original article, the authentic deal. There's no strings attached to this offer. You can talk on the phone. You can talk via Zoom. You can come in and see me. I'd be happy to help you get the year started right. If you had a bad year last year, maybe it's time to do something different, especially if you're close or already retired and you don't have income coming in. Very important to have an income stream safely coming in from a protected portfolio or even an insured portfolio. Jim, you're saying I need a headset? We got to get Jim a speaker. Maybe that's what it is. Me. Yeah. Hey, I'm going to take a quick poll. I got a few people left here. Who has problems hearing me? See that poll deal? Is there a way for me to do it? Hang on, how do we do that? Untitled question. Can you hear me? Can you hear me well? Okay. Did that work? Nancy, did that work? Can they see that? Okay. Tell you what, okay, if people are telling me yes, just go into the comments section and just say, yes, I hear you, or no, I don't. Because you know, I bought new stuff. I really did, just thinking that it was bad. But anyways, I think we're gonna have to get somebody a new $15 speaker from Amazon, and I do that once in a while. So, all right. Hey, thank you very much, everybody. If you have any questions, 949-219-0692, 949-219-0692. I appreciate everybody being on here. If I can help you, give me a call. If you have a friend, tell them about me. You know what I mean? You know, just say, hey, look, here's a guy you should probably talk to. If they've had problems in their portfolio, just give them my name and number, or else just invite them. We're going to do this next month. When are we doing this, Nancy? February 22nd, 3 to 4 p.m. February 22nd. And that one is don't let a recession rob you of your retirement. All right. Okay. Thank you, guys. Appreciate everybody. Happy New Year. I know it's late, but we'll all talk again next month and bring new friends and call me if I can help. 949-219-0692. Thank you, everybody. Take care. Have a good day.